Hey everybody, Luke Gromen. Hope you are well. Had a great Thanksgiving weekend here in the U.S. I know I did. Got to enjoy it with family locally, which always is a good time. So, unfortunately, the Ohio State Buckeyes were unable to pull it out against Michigan, but some more good football coming up this weekend. So, we'll enjoy that. In the meantime, I'm going to jump right in. Thank you, as always, for the questions. Very helpful, very thought-provoking. Really always enjoy them, so thank you. First question is from MT. Why is Jim wrong? Jim Bianco, who said the last time interest payments were burdensome was 1981 to 1988. During this period, the U.S. economy boomed, interest rates fell, stocks soared, and living standards rose. Why? The federal government could borrow to pay this debt burden. And Jim had a great tweet out highlighting some of these issues. I would preface this by saying I respect Jim immensely. I think he's a brilliant mind, very good thinker. Asking me my opinion on his point, in my opinion, he's not wrong. In my opinion, he's leaving out an important piece of the puzzle in that X thread regarding that period of time, which is to say the last time the U.S. government's interest payment burden was as high as it is now was in late 1984. In early 1985, around February, the dollar, as measured by the DXY index, peaked. It fell sharply ahead of the Plaza Accord, in which the dollar was weakened in September of 85. The dollar was down 25% off its all-time high from February 85 to September 85, and it ultimately fell over 40% in 2 years between February 1985 and early 1987, peak to trough. In other words, for the issues that Jim highlighted to be resolved this way again, and I think Jim's right in highlighting these, the dollar needs to go way lower, like not a little lower, like a lot lower. The challenge in that is that our U.S. trade deficit is much higher now than it was then. Our fiscal deficit is much higher. The net international investment position of the U.S. is way more negative than it was then. It was actually slightly positive then, which means there's no assets to be attracted here. They're already all here. The weakening the dollar as much, even close to as much as it was weakened in 84, 85, 86, 87, will likely drive nominal growth up enormously. It will also probably drive inflation up. And again, our debt load was way lower back then. So we could afford higher, stronger growth, higher rates. The rates that would likely result from a much weaker dollar leading to higher growth and higher inflation likely would put U.S. interest expense uncomfortably high and would probably necessitate some version of QE or yield curve control, financial repression on the banks, etc., something like that. So that is, the big differences are the net international investment position of the U.S. much more negative now, negative 65%. So there's not the capital to attract back home like there was in the early 80s. Back in the early 80s, net international investment position was positive 10% of GDP. Now it's negative 65% of GDP. So there was capital to attract back home. Capital's already all here. And then secondly, the debt to GDP is 120% today. It was like 30% back then. Deficits are much higher structurally because of the boomer demographics. So they can do the weaker dollar, but it's going to feed on itself. We'll get the nominal growth, and that's where I think this is going. But I think it's going to be nominal growth, probably with periods of the Fed won't want to call it QE. They'll want to call it market functioning of treasuries, treasury market functioning purchases of treasuries or something like that, or not QE or BTFP or some sort of liquidity injection that they'll deny till the cows come home is QE. But the markets won't care. The markets will respond favorably to any such liquidity. So those are my thoughts on that. Appreciate the question. And like I said, I respect the heck out of Jim Bianco. I think he's a great thinker and a friend. So those are my thoughts on it. From JS, the U.S. eases, but the rest of the world eases more. Thus, we have a stronger dollar after years of printing. No end in sight. Anything that could derail this. I think we just saw what has begun derailing this in August, September, and October of this year, which is to say, a stronger dollar in the face of $13 to $14 trillion in offshore dollar-denominated debt that needs dollars to service. and foreigners who can't print dollars but who have a dollar piggy bank. When you hear me say net international investment position of negative 65% of GDP, what you should hear is US dollar piggy bank for foreigners of negative of 65% of US GDP, or net $18 trillion, of roughly $40 trillion gross, including $7.6 trillion of treasuries. So if the dollar goes up, foreigners get squeezed on their ability to service debt, global growth slows, U.S. deficits get bigger, U.S. Treasury issuance rises, squeezes the dollar higher still, as U.S. government deficits crowd out global dollar markets, and foreigners go to the piggy bank. They go to the U.S. dollar piggy bank, and they sell treasuries. And they will keep selling treasuries. That's more treasury selling on top of what is already too much treasury selling. It gets into a very vicious vortex, which is all fun and games until the treasury market loses an eye. Until you start to see auctions do what we started to see them do 2 weeks ago with that 30-year auction with a 5 basis point tail, which is like, wow. When you start seeing treasury volatility do what it did in early October, late September, that ultimately is the governor on this at this point in the cycle, which is to say the U.S. government is not going to start laying off the United States Marine Corps. They are not going to shut down the United States Navy. They are not going to tell 70 million baby boomers in an election year, we're going to not pay your entitlements for the next 6 months because we have to pay interest to China. It's not going to work that way. What's going to happen? They're going to weaken the dollar. So I think ultimately, there's a lot of different ways they can do that. The Fed doesn't want to. Powell wants to be a tough guy. Great. At the end, they're going to have to weaken the dollar unless he is going to be willing to be the man responsible for forcing the U.S. government to lay off the U.S. Marine Corps, close the U.S. Navy, and tell boomers for the next 6 months in an election that they don't get their benefits. So that is this U.S. fiscal as the bottleneck remains very underappreciated in my opinion, and I think that's a mistake. I think people need to be paying it. It's a bigger bottleneck than inflation. It's a bigger bottleneck than employment. Next question from LT. Curious if your view on oil has shifted over the last month or so and how it fits into your portfolio strategy for 2024. No, not really. It's not felt great watching oil go lower. With that said, there's expectations of pretty pronounced economic weakness now in oil's price, in my opinion. While peak cheap oil is still an issue. The other thing that's been of interest to me, I don't think it matters for oil anytime soon, but watching alternative energy names and more important projects get significantly hurt by interest rates, I think is an important signpost. It tells us these alternatives that are supposed to play a major role in curtailing global fossil fuel usage over the next 10 years so that there's peak oil demand in 10 years or 8 years or whatever it's supposed to be. These projects don't work at 4 or 5% is what the message is, what we're seeing happen with these projects and markets. And so if that's the case, one of two things are going to happen. Either they're going to lower rates, which I think ultimately is more liquidity is good for oil, all else equal, or they're not, and sort of these peak oil demands that are predicated upon, at least a portion of them that are predicated upon rapid growth of alternative energy, they're not going to come true. And they're going to have to, these energy demand forecasts, oil demand forecasts are going to have to be increased secularly versus 8-10 years ago. You're starting to see hints of this when you see the UK back off on their electric car outlooks for whenever it is, 6 or 8 years from now. That's the type of thing you're going to be seeing more of. So I still like oil. I don't feel like there's anything to really do at the moment. It doesn't feel good that it's down from whatever, 92, 94 to 74, 75, 78, wherever it's at. But I'm not losing sleep over it. I don't think it goes to 40, 50 like it did in 14, 15 or negative or whatever, failing an economic catastrophe like COVID, simply given the peak cheap oil issues we've discussed. So, ultimately, I think the outlook for oil remains positive. Next question from SW. You mentioned recently that the U.S. needs a productivity miracle. Which technological efforts are most likely to provide enough of an economic boost within the time frame that we need? How can we rely on the U.S. government to facilitate such developments rapidly? The U.S. government, any government, I don't think they'll move that fast. But things like DARPA within the U.S. Defense Department, different defense. I mean, keep in mind, the internet came out of the USDOD. A lot of the stuff we're using in consumer electronics today came out of DOD. So they've got God knows what skunkworks. I'm sure they're working on stuff that's pretty cool. So there are some things that I'm sure we don't even know about. With that said, what can arrive and what can arrive on a timely basis? And then what does timely mean? So what can arrive, to me, these small modular nuclear fission reactors I think are really interesting. There's some real progress there. There's been some real world tests. That is something I think could be, I think it's just nothing but a win case. AI can be a huge productivity driver. However, AI/robotics have a little bit of a blowback potential. In other words, if AI and robotics happen too fast, they risk causing so much productivity that you create political problems on the other side in terms of too big of layoffs, etc. Tax receipts hits into a Western sovereign fiscal picture broadly that is they cannot afford a hit to tax receipts. So that kind of depends on the pacing. In terms of how soon, I don't think any of these are going to come soon enough because compound interest never sleeps. And we're seeing the fiscal picture hit levels in terms of true interest expense of Treasury spending plus entitlements relative to receipts, hit levels that are nearing critical thresholds that is generally resulted in the dollar being weakened in relatively short order. So I don't think they're going to arrive before that. So timely manner, next 2-3 years, maybe. I definitely think AI and robotics are probably going to be much more pronounced over the next 2 to 3 years. That I feel pretty comfortable saying. The small modular nuclear reactors, I've not seen enough to have a strong opinion on that one way or another. From GR, hearing some rumbling about reverse repo balances going to zero, causing some issues. This pool of money hasn't been around long. Is there any issues of concern here that connect to other probabilities you've talked about? I have thought about reverse repo as a pool of stored up and sterilized QE. So basically, it was QE, it created reserves, and then it was sterilized by the Fed's reverse repo, basically prevented from going into the economy as the Fed basically bribes the banks with the reverse repo to not loan or let the money go into the economy. And that's probably an oversimplification, but that's, I think, the gist of it. So to the extent that that represents what, or is accurate, or is directionally accurate for what reverse repo is, then as reverse repo is drained, essentially going into T-bill markets, and T-bills are being issued to offset government spending, it amounts to sort of this stored up and sterilized QE coming back into the system to finance U.S. deficits in the T-bill markets. And so Treasury is shifting issuance to the front end will accelerate, all else equal, the drawdown in reverse repo, as I understand it. And so when reverse repo starts to get too low, it will start to, I think, potentially create some concerns on some of the liquidity issues that we've talked about before. Dollar liquidity, it should support the dollar. It should be non-stimulative, if that's a word. It should be contractionary. If the reverse repo runs out while issuance continues to grow apace. I mean, there's some other stuff in money market funds, but it's to the extent that it's sterilized and stored QE that's running out. I think it's contractionary to the extent it runs out, all else equal. Is how I'm thinking about it at the moment. So hopefully that helps. Quite honestly, I have to give the Fed credit. It's really, they've managed that well in terms of being sort of able to bleed that stimulus, take that stimulus out that was sort of a real huge amount and sort of bleed it out over the ensuing 2 years with the buildup and then rundown of reverse repo. But that's going to be coming to a head, it looks like, in the first quarter. So it is something important to watch and definitely paying attention to it. And then the final question from CMC, what do you think about the demographic dynamics of the world currently and their impact on growth? I think it depends. It depends on events. There's, in some circles, a black and white view of young demographics are good, old demographics are bad. And there's a real good chance that view of the world is not just outdated, but wrong. For example, nobody has better demographics in the world, as far as I know, than the Mideast. But lots of young unemployed people without economic opportunity can be very politically destabilizing, as we've seen for a long time and as we've sadly seen in spades over the last month. AI and automation and robotics all combined run the risk of creating lots of youth unemployment with not a lot of hope for economic advancement or opportunity. If that happens, all else equal, the countries that have old demographics will probably have higher standards of living and, more importantly, be more politically stable than those with lots of young people, paradoxically. Older people don't protest violently, to be blunt. So that is the reason why I think it depends on events and how they unfold. You sort of had some hints around that with this recent OpenAI situation, where you could read some of the hypotheses that there were some new programs to be rolled out, or I'm not using it right. I'm not a techie guy. I apologize. But whatever this new AI, that there were reportedly possibly some concerns about the socioeconomic impacts of it on employment, etc. That's exactly what this speaks to, in my opinion. You take away hundreds of millions of jobs of young people around the world, that runs the risk of politically destabilizing the nations with the better demographics versus the worse demographics. So I think it's something we all have to think about in terms of how rapidly deflationary tech is, and how exponentially some of this really cutting edge stuff in AI and robotics is growing, and what that implies. So that's it for today. I appreciate everybody joining. As always, if you like these updates, check out FFTT-LLC.com for more information about our Tree Rings product, 10 most interesting things, brief synopsis about what grabbed our attention about it, and how it either changed or reinforced how I was thinking about the topic at hand in the world, and get a lot of great feedback on it. So check it out. In the meantime, everybody have a great rest of your week, and I look forward to chatting with you soon. Take care, everyone.